Agricultural Economics 3, Production Economics. Introduction. Production economics is the study of how resources are combined in a production process to produce goods and services in the most cost-effective and profitable way possible. Topic objectives. By the end of the lesson, you should be able to explain various parameters of national development, relate national development to agricultural production, state the factors of production and explain how each affect production, describe how the law of diminishing returns relates to agricultural production, describe agricultural planning and budgeting in a farm business, state sources of agriculture support services, describe risks and uncertainties in farming, and explain ways of adjusting to risks and uncertainties. Background information. In Book 1, you are introduced to the basis concepts of economics, namely scarcity and choice, preference and choice, and opportunity cost. In this topic, you will study how these principles are applied in production of agricultural goods and services. Suggested activities. Students to prepare a partial budget of their agriculture project plot. The teacher to guide the student on how to prepare the budget. The teacher to guide the student on how to draw production function curve using locally available data. Working in groups of 3, copy the data into your notebooks. Complete the table. Use the data to plot a graph on production function. Determine the zones of production on the production function. From the graph, determine the most productive zones. State the reasons for the answer above. Working in groups, discuss the law of substitution and its importance in agricultural economics. Identify joint products and competitive products found in your community. Interview reputable farmers near the school and ask what kind of risk and uncertainties they faced and how they can overcome them. Match the terms given below with a statement that appropriately defines them. By clicking on the appropriate buttons, identify the areas in which agriculture contributes to national development. Match the following figures with the respective production functions. Match the following figures with the respective production functions. By clicking on the appropriate button, identify the statements that don't constitute an agricultural risk. Drag and drop the factors of production to their correct statements. In the year 2010, the Kenyan population was 37 million people. The gross national income was 7,400,000,000 shillings. Calculate the per capita income for Kenya during the year 2010 and click on the correct answer from the alternatives given below. Agricultural Economics 3, Production Economics. National income and factors of production. National income. National income is the total value of goods and services produced by a country in a given year. Household-farm relationship. A household is a unit comprising of the individual farmer and members of the family. Relationship between household and a farm. The farm sells goods and services to the household and earn income, for example, fertilizers, bread, sugar, etc., while the household earn income by providing raw materials and labor to the farm. Gross domestic product (GDP) and gross national product (GNP). Gross domestic product. Gross domestic product is the sum total of goods and services produced by the residents of a country within 1 year. Gross national product (GNP). Gross national product is the sum total of all goods and services produced by nationals of a given country within 1 year, regardless of their country of operation. Gross national income (GNI) and per capita income. When gross national product is expressed in monetary terms, it is called gross national income. Per capita income is the average income per head in a country in 1 year. It is arrived at by dividing gross national income by the country's population. Contribution of agriculture in national development. Agriculture contributes to the national development in the following ways: source of raw materials for industrial development, source of employment, source of foreign exchange, source of income, improvement of infrastructure, and source of food. Factors of production. Factors of production are resources required in the production process. Land is part of the earth where agricultural production takes place. It is also the space where farm buildings, agro-industries, and urban centers infrastructure are constructed. Capital. These are all man-made assets that are used in production. Capital may be in forms of liquid capital, working capital, and fixed capital. A farmer may acquire capital from personal savings, loans from credit institutions, and free grants. Management. This is the process of planning and decision-making in organizing the other factors of production. Management aims to minimize the total cost of production and maximize the total revenue. A farm manager plans for the farm's activities, implements the plans, detects weaknesses in farm production processes, keep appropriate farm records, gather and analyzing market information. Roles of a farm manager. A farm manager has many roles in managing the farm enterprises. He or she should plan for the farm's activities, implementing the planning, detecting weaknesses in farm production processes, keep appropriate farm records, gather and analyzing market information. He or she heads the farm operations. Labor. This is human force and skills employed to perform work in a production process. Labor can be classified as family labor and hired labor. Hired labor is further classified as casual labor and permanent labor. The labor may be improved by training, giving incentives, labor supervision, and assigning tasks according to skills. Production function. Production function is the physical relationship between inputs and outputs. Farm planning and budgeting. Farm planning. Farm planning is the organization of all necessary resources such as land, capital, and labor so as to achieve the specific objective of the farm. Factors to consider in farm planning are size of the farm, environmental conditions, government policy and regulation, farmers' objectives and preferences, transport and communication, and security of the enterprise. Steps in farm planning. Farm planning starts with determining the farm size and the environmental situation. The farmer's objectives and preferences are then determined. Determine size of the land. Determine environmental situation. Determine farmer's objective and preferences. Develop tentative schedule. Establish technical feasibility of the plan. Determine a budget. Develop a financial flow. Implement the plan. Carry out evaluation of the plan. Farm budgeting. A farm budget is an estimate of the future income and expenses of a proposed farm plan. Types of farm budgets. There are two types of farm budgets, that is, partial and complete budgets. A partial budget represents financial effects of proposed minor changes in a farm organization and is guided by the four questions, namely, what extra costs are incurred, what revenue is foregone, what extra revenue is earned, and what costs are saved. Agricultural support services available to the farmers include the following: extension and training, credit and banking, AI service and marketing, agriculture research, farm inputs and marketing, and tractor hire services. Risks and uncertainty in farming. A risk is the difference between the expected and the actual outcome. Uncertainty is the imperfect knowledge about the future events or outcome. Common risks and uncertainties. Common risks and uncertainties in agriculture are outbreak of pests and diseases, fluctuation of commodity prices, ownership uncertainty, sickness and injuries, obsolescence, natural catastrophes, and change in technology. Ways of adjusting to risks and uncertainties. Ways of adjusting to risk and uncertainties include adopting modern methods of efficient production, flexibility in production methods, input rationing, taking insurance cover, contracting production processes, and diversification of enterprises. Agricultural Economics 4. Introduction. Farm accounts are written farm records of all the financial transactions in the farm which evaluate its performances. Financial documents. A financial document is a record in form of written piece of paper or electronic form of record giving information of expenses, assets or monetary status of a firm. They include the following: invoice, delivery note, statement of account, and purchase order. Invoice. An invoice is a financial document used when goods are delivered on credit. It is used to inform the buyer of the goods delivered on credit. An invoice contains several types of information. For example, particulars column, quantity column, name of the seller, name of the buyer, price per unit column, and amount column. In addition, it also provides discount, if any, terms of payment, and payment period. Receipt. A receipt is issued when payment of goods delivered or services rendered are made. It shows that payment has been made. Delivery note. Delivery note is a financial document written by a seller that accompanies goods on delivery. It helps the buyer to check if all goods have been delivered. The delivery note shows that goods have been physically delivered from the buyer. Purchase order. Purchase order is a financial document written by a buyer when requesting a business firm to supply specified goods. Statement of account. Statement of account is a financial document sent by a seller to a buyer who has bought goods on credit over a period of time, that is, specified trading period. It is a reminder to inform the buyer how much he owes the seller. Books of account. These are books into which information on various business transactions are recorded over a long period of time. They are also called financial books. The financial books used in the firm include cash book. A cash book is a book where transactions involving the receiving and paying out of cash are recorded. Inventory book is the financial book where all the assets owned by the firm business or an individual are entered. Inventories are drawn at the end of an accounting period. The inventory records are divided into two: consumable inventory and permanent inventory. Consumable goods include fertilizers, seeds, feeds, etc., whereas permanent goods include farm tools and machinery. Journal. It is a book of account of original entry where all transactions are recorded from day to day. Journal contains all unclassified transactions. It is also called the book of prime entry, that is, transactions are made prior to their entry in the ledger. Financial statements. These are statements which show various financial transactions on the firm. They include the following: balance sheet, profit and account and cash analysis. Agroforestry is defined as the practice of growing food crops and agroforestry trees and shrubs, keeping livestock on the same piece of land at the same time. pruning and training. Any part of the seedling unwanted due to breakage, overcrowding, pests or diseases and productivity is removed through pruning. Grafting old trees. It can be done using bark grafting or cleft grafting. Agroforestry practices. Various practices carried out in agroforestry include